Welcome to this explainer. Today, we are diving into a really fascinating tension that's currently pulling at the seams of global financial markets. On one side, we've got the spectacular skyrocketing valuations of tech and AI stocks. But on the other side, a looming market correction and a massive strategic pivot by smart money into something completely different. So let's unpack exactly what's happening out there right now. Tech and AI stocks have been hitting record highs in the US and parts of Asia, and honestly, it feels like an unstoppable train, right? But we really have to ask ourselves, is this massive surge sustainable? Are these companies actually worth these astronomical price tags right now? Or is the market just running on pure adrenaline and hypothetical futures? Financial expert Michael McCarthy really hit the nail on the head here regarding a massive vulnerability hovering over AI valuations. He argues that the US market is currently priced for perfection. That means current stock prices leave absolutely zero room for error. Any shadow of a doubt that AI is going to flawlessly revolutionize the economy tomorrow, well, that could trigger a rapid, massive downward correction in US shares. To truly grasp the risk we're looking at, we have to understand the sheer scale of the situation. We aren't just talking about a few $1 million changing hands here and there. We're talking about hundreds of billions of dollars. We are seeing incredibly large companies literally doubling their share prices in a very short amount of time. That is a spectacular amount of value creation happening almost overnight. But, value creation of that magnitude carries a very heavy burden of proof. And that leads us to a critical vulnerability. Sky-high valuations absolutely must be backed by real, tangible profits. While immense, eye-watering amounts of capital are pouring into chip building and product creation, the reality of the actual profits remains a giant question mark. We simply haven't seen yet how end customers are going to pay the premiums required to justify these soaring stock prices. Section 1. The agitation, a looming U.S. market correction. There is a stark, undeniable contrast right now between investor expectations and macroeconomic reality. Previously, the U.S. share market aggressively priced in the expectation of 2 interest rate cuts. But the current reality? 0 cuts. Nada. Interest rates are actually headed higher globally, but U.S. share markets haven't quite priced in this new reality just yet. And that disconnect? It's incredibly dangerous. There's a very real risk that U.S. investors are going to experience a sudden dawning, a sharp realization that interest rates might actually be going up instead of down. When that wake-up call finally happens, and you combine it with those sky-high tech valuations we talked about, it's highly likely to spark a major corrective move in U.S. shares. Section 2. The solution, safe havens, and the halo trade. So, understandably nervous about these top-heavy AI stocks, investors are actively diversifying. We are seeing funds being redeployed away from those extreme technology valuations and straight into smaller cap companies. The U.S. Russell 2000 Index, for instance, has been rising more strongly than the broader market as investors look for ways to spread their risk. But there's another, arguably even more fascinating pivot happening out there, and it's called the halo trade. Halo stands for Heavy Assets, Low Obsolescence. It's a remarkably straightforward strategy. You invest in big companies with massive physical footprints that are essentially immune to being disrupted or made obsolete by artificial intelligence. In the real world, this halo trade targets core assets. Think of global mining giants like Rio and BHP, or massive infrastructure plays like Transurban. These are tangible, physical assets that take years to build and reliably produce regular income. Let's face it, an AI chatbot cannot disrupt a physical toll road or an iron ore mine. Investors are really facing a clear dichotomy right now. On one hand, you have the intangible, high-risk growth of the tech and AI sectors, where profits are largely hypothetical at this stage. Contrast that with the grounded physical reliability of the halo trade and steady, income-based businesses. Smart money is actively seeking out these reliable characteristics to stabilize their portfolios against the wild volatility of the tech world. Section 3. The local reality, global trends in action. First, we have to acknowledge the broader geopolitical volatility impacting markets everywhere. For example, the Australian benchmark index, the ASX 200, dropped roughly 6% over a recent 3-month period. This occurred amid tense, ongoing geopolitical conflicts, specifically following attacks between the US, Israel, and Iran. It's a stark reminder that markets absolutely do not operate in a vacuum, and global instability is a constant factor weighing heavily on investor sentiment. So, why did the Australian market underperform while US markets hit record highs? Well, to put it in perspective, Australia represents only about 2% of the global economy, and its market is highly concentrated. Roughly two-thirds, 66% of the Australian share market by value, is made up of banking, finance, and resource-based businesses. Without a massive, glamorous technology sector to rely on, a market that heavily weighted in resources and finance naturally just misses out on that specific AI boom. However, there's a highly localized factor accelerating this shift away from growth stocks down in Australia. Recent controversial changes to their capital gains tax regime mean that capital growth is no longer the incredibly attractive proposition it once was. With capital growth now taxed at the exact same level as income, the tax environment effectively penalizes high-risk growth investments, which inherently carry much more risk than steady income generation. Investors are reacting totally rationally to these new rules of the game. Because growth is riskier and taxed just as heavily, they are shifting their focus to spending in the here and now. Portfolios are actively tilting toward higher dividend stocks, specifically those offering franking credits, which remains one of the few tax advantages left for individual investors in that market. This local reality acts like an accelerant, dumping fuel on the broader global trend of nervous investors abandoning growth for reliable income. Okay, so we've explored the massive AI valuation gap, the potential for a severe market correction triggered by interest rates, and the strategic rise of the physical income-producing halo trade. So, looking at your own financial strategy, does it favor speculative future growth or reliable present income? It's a fundamental question every investor absolutely must answer in today's fascinating, high-stakes environment. Thank you so much for joining me for this explainer. Keep learning, and I'll catch you next time.